All right, everyone. My name is Alex Perney with Advanta IRA, and I'll be your moderator today for our wonderful guest presentation with local real estate investor and nationally known individual Peter Fortunato. We're going to be spending about an hour today going a little bit free-form with things that do and don't work, details to watch out for, and just a lot of really good information that if you're new to investing or even a seasoned investor with regards to real estate investing or creative deal making, that's going to be very beneficial for you. One thing that I do want to let you know is that please do make sure that you type in your questions. This presentation, as that I've done them with Pete in the past, they go very well and they're very enriching so long as that you ask questions, because the back and forth between Pete and I, although it might be stimulating and entertaining, it won't get you the good information that ultimately you need in order to help further yourself and your endeavors. So please do ask the questions. He's a seasoned expert. Myself, I can certainly help more of the technical stuff with regard to retirement plan investing, because a lot of the things that we're going to cover today can be structured to help you significantly mitigate your taxes within IRAs, 401ks, and other types of retirement plans. So just make sure that the questions, you need to type them in. I will moderate them because all of the audio on your end has been muted. So please do type them in and we will address them as soon as they come up. And again, thank you very much for joining us today. Now, before we do anything, obviously we have to satiate our attorneys. So Advanta and our employees, we do not provide legal, tax, or investment advice, nor do we endorse any investment products. All information and materials are presented here today from both parties are for informational purposes only, and all parties are encouraged to consult with their attorneys, accountants, financial advisors, spouses, and anyone else that would be qualified to advise you on your financial matters before entering into any type of financial agreement. With that said, a little bit about us. Here at Advanta, we have well over 20 years of combined industry experience in doing what we do. We've been in operation since 2004 here in the Tampa Bay area, but we operate nationwide and internationally. So if you have a deal that you're trying to do and you're trying to maybe make it work in your retirement plan, just don't understand that there's no limitation as to where we're located or where you are located. We can make the thing work and ultimately work with you to that end as well. And an interesting milestone, we just recently crossed over $1 billion of capital assets under management. So for any clients that are attending today, we do thank you for helping us grow and reach that milestone. And for any people out there that are looking to become clients, we would love to have you be part of the family as well. So please just let us know if you have any questions. We will be happy to get that to you. So now I would like to hand it over to our guest presenter today, Mr. Peter Fortunato. Peter has been doing this for well over 40 years of creative deal making and investing throughout the primarily on the East Coast, hailing originally from, I believe, Beverly, Massachusetts. Is that correct, Pete?
It is.
Originally from Beverly, Massachusetts. He's been doing this since he graduated from high school. We have been fortunate enough to come to call on him for many questions and a very trusted resource for many of our clients and many other people around the area. He's a wonderful person to know, and I encourage anyone that is in the area to drop by any one of the local RIA meetings or one of his classes that are probably, in my honest opinion, probably one of the best bangs for your buck with regards to education and real-world experience that you can get from someone that has been actually doing this for a very long time. So with that said, I'd like to hand it over to Pete. There will be some information regarding his class that he is teaching at the end of June at the end of this, as well as some registration. So if you'd like to get more and you'd like to kind of understand more of his viewpoints on things and the like, understand that there is a class coming up that you can attend. It is in the Tampa Bay area, and we'll get more to that a little bit later on. So Pete, I'd like to turn it over to you. We do have one question, and I'll fire that off to you in a minute. Any opening remarks that you'd like to get out?
I'm ready to go, and I'm looking forward to getting some questions and perhaps some suggestions.
Okay, this is a pretty good one because I think we both probably have a little bit of an opinion on this. Lisa asked, my CPA said not to purchase properties in an IRA because I lose all the deductions. What's your opinion on that?
Okay, well, first of all, just recognize I've been doing this for 50 years, and I am extremely opinionated and more than happy to share my opinion.
There you go.
I don't agree with the CPA who said, don't do it because you lose the deduction. I think you don't do it. I don't invest in real estate in my IRA because I don't want the liability that is a part of real estate to be inside my IRA. I have very much protected assets in my IRA, and to have a slip and fall or a repairman who's got a beer in one hand and a power saw in the other create a problem in my IRA, I just don't want to do that. So I've not put any real estate in there. Now, that said, because I do hear that question a lot, and I have many friends who've invested their IRAs heavily in real estate, and looking back and seeing how very successful they've been, I would be lying to you if I said they weren't successful, because I've seen very many successful IRAs invested in real estate. When I do that, I want growth and I want income in my IRA. I like real estate. I believe in real estate. My capital base that is going to fund my lifestyle is based on real estate. But I try to control the growth with an option or with an equity participation note or with amortization in a wraparound note. I try to control the income with a note rather than with rent, because I'm trying to stay out of the action that rentals and tenants involve my IRA in. So while I absolutely believe in real estate, and that's almost all I invest in, my IRA owns no real estate. I've been sorely tempted, but because of the liability issue is the reason that I have avoided having any real estate in my IRA.
Sure, and it's a very good point. Lisa has another good question, and I can speak to this a little bit, and Pete, jump in after I'm done. Isn't an IRA protected from lawsuits by design? Well, the protection that you're probably looking at is personal creditor protection, where let's say you personally get sued or you have something that generates a libelous action towards yourself personally. Yes, to an extent, IRAs can be protected from having an automatic creditor judgment that is assessed to you personally extended to your IRA. However, IRAs are their own entity. If it owns a piece of real estate like Pete was talking about, there's liability in that. If someone trips and falls, or you have the handyman with a beer in one hand and a circular saw in the other, Pete, I'm going to use that one in the future. The owner of that property is the IRA. So when Morgan & Morgan or whoever comes to sue the person that is owning the property, the IRA can actually be sued. And the IRA in and of itself, each individual one is relatively insular from the other ones. So that particular IRA that owns that particular house would be subject to a particular lawsuit. And that could, extend to having the house be part of a judgment or have something like that happen. So yes and no. IRAs can be protected from lawsuits. It just depends on where that lawsuit's coming from. So it's important to understand the demarcation between those two. And I'll turn it over to Pete for a little bit more elaboration on that. And Rob, I do see your hand raised. If you can type in any questions you have, we will certainly address those. Thanks. Pete?
Okay, I agree with you, Alex. That's exactly what's going on. If somebody had a judgment against me, it's unlikely that it would attach my IRA assets, because most pension funds are relatively insulated from creditors. However, if something happened inside, that's why I gave that example of the guy with the beer and the power saw. If something happened inside the property, inside an asset owned by the IRA's assets are at risk. And I think you can control growth and income. It's net worth and income that I am after in my IRA. And I don't need to take on the liability. I don't need the property in there.
Exactly. David, I see your hand raised. If you can type in your question, we'll jump onto that one. And Pete, a little bit more to the point about limiting liability. You had a good quote that I've heard you say a few times, is that, when someone walks into a house, they can trip and fall over an uneven surface, but they don't trip and fall over a piece of paper. Meaning that, if you have paper assets or other ways to control real estate or have an interest in it, it can help to mitigate that liability and be a good fit for an IRA in most times. Could you elaborate maybe on some of that and how you identify some ways to get involved in real estate that aren't, owning it like a rental in an IRA?
All right, Alex, do you have the picture of the house up so they can see that?
I do.
See, I can't see because I'm just on the telephone here. But in any case, I use a picture of a house to remind me of all the different pieces of every deal. And in my IRA, the pieces that I want are income and growth, net worth, growth and amortization, net worth. I don't want use. I'm not going to buy a property in my IRA and then use it. I don't want the thrill of management inside my IRA. I don't need the tax benefits in my IRA because I already have a tax-deferred or a tax-free entity holding my real estate. In all cases, you need the security, which you'll see there on the house. If people don't feel secure, they won't make a deal. But essentially, since the benefits I'm after are increase in the net worth of my IRA and then income in my IRA, I'm using notes, options, and wraparound notes or equity participation notes, which is kind of a combination of a note and an option. I might buy a remainder interest in property in my IRA, which will give me a long-term control of a property without any current ownership. But I've not done that. I have done options in my IRA, and I am very happy with the options I've done in my IRA.
Yeah, options are certainly a good thing, and I'd like to touch on that a little bit more. David has a good question. I'll take the first portion of this because I have a good amount of experience. If the property is owned by an LLC, owned by an IRA or 401k, does this strategy offer significant or sufficient liability protection? The best answer is it depends. And it depends on what state you're in, what state the LLC is in, what state the property is in. To give an example, in the state of Florida, a single-member LLC, by design, does not offer creditor liability protection to the sole member. That is court case law that is handed down by the Supreme Court of Florida. Off the top of my head, I can't remember the exact case and docket number, but they don't offer the liability protections offered to multi-partnerships and multi-member LLCs like you would see in a more traditional limited liability partnership. It kind of just passes that liability up a little bit. So depending on how you have it structured, it may or may not, and that varies from state to state. Each state has its own corporation and liability laws to an extent of things like that. So yes, it can. My biggest recommendation to any IRA holder that is interested in holding tangible real estate, actually holding title to the real estate, is make sure you talk, and this kind of goes with a lot of things in life, especially investing, is talk to a living, breathing insurance agent, someone that's been doing it for a long time that understands a lot of liability things, and make sure they know it's in an IRA and that you have enough coverage for whatever type of typical liabilities are associated with that property. Because 9 times out of 10, when someone gets sued, they're coming after a settlement from the insurance company. Rarely does it extend past that unless there is some, gross negligence or a lot of other things happening. So making sure you're properly insured on your IRA properties is the first thing that I tell clients before looking at structuring of LLCs and things like that. Make sure you have proper and good insurance, because if you don't tell your insurance agent or the policy doesn't know that it's an IRA property or it's covered under a personal or a corporate umbrella, they find out it's in an IRA, they're going to try to deny coverage. So making sure that you have insurance set up properly and the ability to pick up a phone and call someone and say, hey, Mr. Insurance Agent or Mrs. Insurance Agent, this is an IRA property, and making sure it's properly insured is the first line of defense that I tell people to kind of look at. Pete, do you have anything else to add to that point?
Not really. If I were going to buy real estate in my IRA, I would surely use trusts and LLCs, some sort of a structure or an entity to create more insulation. But I have chosen not to have any real property in my IRA and to avoid that issue altogether. If I had any property in my IRA or otherwise, I would want some liability coverage and very, very good liability coverage. That doesn't mean just talking to your insurance agents. It means talking to them, buying coverage, and actually reading the policy to see what it says, or having somebody read it to you so that you understand the liability. The other thing I have found in really 50 years of real estate and 50 years of having tenants in real estate that I've controlled or owned, the liability issue begins with your own activity and attitude. And the best way is to really be careful of how you take care of people and look after the people you do business with. And that's a key to capitalism in all forms. Capitalism means helping other people and in return being helped yourself.
Very good point. I got two questions that pop up here. Robert, I'm going to get yours first, and then Lisa we'll use yours as a segue. It says, Pete, as one who often self-insures, how do you feel about that insurance? Answer. Real quick, Robert, on that, mainly I was focusing on the liability portion of it, and Pete obviously was as well in his. But keep in mind, with IRA-owned properties, even if you are someone who self-insures personally owned properties, the IRA is the one that has to incur the burden of any repairs or any expenses with that property, so you couldn't necessarily use your own personal funds as a quote-unquote self-insurance pool for damages and things like that. So whereas you can certainly utilize a damage type of self-insured mechanism for an IRA, just keep in mind the IRA is the one that has to have those funds. Pete, just to his question, as someone who self-insures, how do you feel about the whole insurance platform?
All right. Well, I have self-insured the property. Now, not liability. That's a whole other issue. And I have done it since 2003. And I wish I had started doing it before. And all those funds that we would have been spending on premiums, we've used to buy more property. And sure. I felt really, really, really good about it until this past hurricane season, when 4 of our roofs left, 2 trees fell on. So thank God this wasn't our first year self-insuring. So
yeah,
indeed,
absolutely.
Just so you get an idea, we've had some wonderful, wonderful years. This year was a difficult year for those of us who self-insured.
Yeah. And just like with anything, there's peaks and valleys. So, Robert, great question. And Robert asked, so you still get liability insurance even when you self-insure?
Oh, yeah. Self-insure, the bricks and mortar, is not the same as running the risk on liability. Liability insurance you really do want to have if you're going to be dealing with the public at all.
Exactly. Because keep in mind, if you don't have the liability insurance, that liability passes to you and your personal self. So, I mean, that that $100,000 of liability insurance you have that lawsuit may have stopped at, if it comes and that lawsuit arrow hits you and you are significantly higher worth and have multiple assets past that, I mean, it can get pretty messy pretty quickly. So liability insurance certainly is something that is kind of a necessary evil. You don't want to be paying those premiums, but when you do need it, you definitely want to have it.
Well, and if you were involved in a situation where someone else was hurt, you'd like to have the capacity to make them as whole as possible.
Exactly.
To fix what, so if you actually did damage, hence, it's a substantial liability insurance on our cars and no real property damage on the cars. If our car gets wrecked, we'll get another car. But we want to be able to take care of someone in the event that someone was hurt in something I was involved in. So that's really the insurance thing. It's not simply about getting away with it. It's about making sure you can take care of people when you need to.
Absolutely. Lisa, going to use your question as a little bit of a segue, so don't think that I forgot about you. So Lisa asks, is it true that having checkbook access to an IRA investment is a red flag for audit? And for those of you that don't understand what she means by checkbook access or checkbook control, sometimes clients in some regards will, instead of just buying a asset or lending a note or doing things directly under Advanta as the custodian and administrator of the account, they will elect to form a newly formed LLC typically, sometimes you can use a trust to the same effect, that their IRA will own, and then they will self-manage. They will write the checks out of that LLC. They will manage all the assets, collect the income back into that LLC, pay expenses, etc. So just kind of make sure people understand the foundation of that question. So is it true that having checkbook access to IRA investments is a red flag for audit? Not necessarily, but it can depend. Just like with anything in life, and it goes doubly true for investing, it kind of depends on what you're doing. Just by the virtue of the fact that, let's say, myself, Alex Perney, I opened up an IRA, had an IRA-owned LLC, and I literally just let the money sit in a money market account in that LLC. By virtue of the fact I just had checkbook access to that IRA-owned LLC, the IRS doesn't necessarily know that. They may know that I am the manager of an LLC by virtue of a state filing and articles of organization that I am named as a manager and an interested party, but the operating agreement that shows that my IRA is the sole owner of that property or of that LLC, that's not public. So they really have no way of knowing. We don't report to them on your IRS Form 5498 what you hold. We just give them the account value, your age, whether it's a Roth, traditional, or what type of account it is, and whether you're of the required minimum distribution age, which is 70 and a half. So in that case, no. But let's say you're doing something in that LLC that is an audit risk. There's a million different ways to be a red flag for an audit, but that would be more to the fact of what you decide to do with that money that might create a red flag for an audit, more so the fact than just by the virtue of having that general structure set up like that. So just understand that it's, like I said, it's one of those things that can honestly really depend on that. And Pete, I know you have some experience with, not necessarily the checkbook control portion of things, but utilizing trust. Maybe you want to speak a little bit to that, of maybe some of the benefits that clients might see if they want to go that route.
Okay. All right. Well, I have used trusts as part of my estate plan, so I'm very comfortable using trusts with regard to all my investments. So my IRA, when formed, one of the first directions that I gave my custodian was to execute a trust, ask someone who I trusted if they would serve as trustee, and when they accepted and signed the contract, then fund that trust. And then I directed my IRA to direct the trustee of my IRA's trust to take what actions, in his opinion, would best increase the net worth and the cash flow of the trust that my IRA owned. Now, if you just listen to that, you can see why most people probably should not do that. They should simply invest in their IRA and have their IRA invest in the notes, the options, the stock market, whatever it is that they know, that they understand, that they believe in. It created a level of complexity that I think most people aren't ready for and don't need. I've found that when I talk to people, they have an IRA-owned trust, and they confuse that with, first, their IRA. Second of all, they confuse it with their own trust. And so they start self-dealing because they believe the IRA's trust is their trust. You need to honor the entities, and I think the more entities, the more difficulty you can have. The other question about the self-direction causing an audit, I don't think self-direction would cause the audit at all. But I do think that in the event that you were audited, if you've been self-directing by writing the checks, then you've been personally involved in your IRA's funds. And so I would not have a checkbook IRA, checkbook LLC, any of those things. If I had a 401, which specifically allows the beneficiary to be the trustee, then I would be very comfortable with a 401, as the beneficiary of the 401 being the checkbook writer.
That's a very good point of bringing up the unnecessary complexity, and I'll kind of bring a real life example of one I saw with, and two examples of one when this kind of thing does work, and I kind of encourage clients to get advice on doing it properly. I had a client come to me. She was recently retired, and this is about as middle of the road as it gets. She was recently retired, had about, I want to say $190,000 in an IRA. She brought over about 120, and she had listened to whatever information about doing a checkbook IRA, was really into it, and we started going down the path of getting her operating agreement drafted, working with an attorney, and getting to know more about the deal she was doing. She was purchasing a condominium in a 55-plus community. It had part of the HOA was maintenance for the unit. It already had a long-term, I believe, 5-year tenant in there that was, and the woman lived alone. She was only in her mid-60s, I believe, so she was still very young. And I asked her, I was like, what's the real goal for having this LLC? And she said, oh, well, so I can write the checks and have this tight control and everything. And ultimately, looking at it objectively, she decided not to go with it because she had the property manager in place that was already paid for by the HOA. She had a tenant that really didn't need too much, and the condominium building, I think, was 10 years old. So in that case, it just didn't really work for her. It was an extra expense that she didn't need to pay for the operating agreement, annual dues for the LLC to be registered in that state. Just she didn't really need it. She could do everything she wanted to directly through us as the administrator, rather than having that extra layer of complexity where she could, and by no malicious intent, maybe mess something up. However, when I have clients that come to me and say, hey, Alex, I'd really like to do things like tax deed auctions or property auctions, or things that involve the ability and requirement to have a check written right at the point of sale, and really does not leave us the administrative time to, even if we get a check written the same day, to get it across the country to Lincoln, Nebraska for the purchase of an asset. That is when the checkbook control type functions of the LLC or a trust really kind of shine, with the ability to have your manager or trustee be present at an auction or something and then ink a check right there. That is when those types of entities really come into play, of really shining and allowing you a little bit more diversity than what you could do directly underneath of the IRA itself with us administering it. And there's varying degrees of how well that holds up. There might be things that the LLC or trust does a little bit better than the IRA, but maybe not well enough to justify the complexity. So just understand that we like to talk to people, and everything's different. And Pete, I think you share a lot of this same sentiment, is that it always helps to talk through something. Have that conversation with your either investment advisor or your custodian, and just kind of talk through it. It's always good to kind of get it out there and see if there's any other ideas or other ways of doing it, or if the way you're doing it really is the right way, then fantastic. But just having that conversation with people is really kind of a good basis to start with regard to choosing what structure you want to go with. Pete?
Well, as an example of that, years ago, I inherited 2 IRAs from my mom. And I've got them there at Advanta, and I knew I had a traditional, that I'm the beneficiary of my mother's IRA, and I had a Roth. And so as I'm now getting ready to roll or to convert, do a trustee-to-trustee transfer from my old custodian to move my older IRA over to Advanta, I sat down with Larissa the other day and explained what I was going to do, and said, well, I can just move it into my existing Roth at Advanta. And the next day, she called me. She said, that Roth was a traditional you inherited from your mom that you converted to a Roth. And therefore, it's not the Roth from the get-go, so it doesn't work. You'll have to roll over, or you'll have to trustee-to-trustee transfer into a brand new Roth at Advanta, or change custodian on an existing Roth. Had I not had that discussion with Larissa, I would have missed it, because I have for years said, well, I got a Roth and a traditional, and I knew that my Roth at the other custodian wouldn't roll into the traditional. That wouldn't make any sense. But it didn't even occur to me that a Roth IRA that was created from the inheritance of a traditional would have created a problem. I had totally forgotten that I had caused it to convert. And so had we not had the discussion, I might have made a very expensive mistake.
Exactly. The discussions are a very big thing. I mean, personally and professionally, I always think that, the degree to which people have kind of gotten away from having a just a cordial discussion, a 10-minute phone call of how much that can really help you understand everything in life, especially with investing, considering it's something that is not, you don't wake up in the morning and have a large cup of investment. It's not necessarily the thing that keeps you breathing and going down the road. It is a secondary nature to what you do every day. So just having those conversations will get you very far and ultimately will really help you. Lisa has a good question right here. And Pete, I know you can really talk to this as well, so I'll take the first part and you can take the second. I've heard that if you make a mistake on a self-directed IRA investment, the IRS will confiscate the entire IRA. Is that true? And if so, is it better to have multiple IRAs? It seems the cost would be high for that. So just like with everything, let's break this down into a few parts. So if you are deemed to have committed engaged in, it's probably the best way to phrase this. Engaged in, made a mistake, and actually had a prohibited transaction, there is the potential that they can disqualify your IRA. They do not confiscate the whole thing. So it's not like they come in and, like the Gold Act and take everything. They will disqualify it as of January 1st of the year in which the prohibited transaction was deemed to have committed, and then this period of window of a prohibited transaction goes back 7 years. So in the past 7 years, if it's happened, this can potentially go this way. So, you stand to lose a substantial amount of the IRA if it's a traditional and you're under the age of 59 and a half. You have early distribution penalties. You have to refile taxes for the applicable years, going back however many years it was, for this extra income that you have. However, the disqualification of a full IRA is not a common thing. I've seen clients get, have issues with the IRS and more times than the disqualification happens, they'll get hit with a penalty. They'll have to take something as a partial distribution or something. They do disqualify IRAs. It is a real risk. But, it's just like with everything, there's a degree of severity that goes along with it. So what I would say to you is that obviously being careful is the name of the game. That's where kind of the checkbook control function of the LLCs or trusts, of the additional complexity that Pete and I went over, can certainly kind of funnel into this kind of thing happening, an egregious prohibited transaction. So something like that would really be something in the back of my mind if I was looking to do that. 401ks are a little bit better protected from that. They don't necessarily have the atomic bomb effect on your IRA or your 401k if you are deemed to have engaged in a prohibited transaction with that. So just be aware that, yes, mistakes can be extremely costly in a IRA. Having multiple IRAs, yeah, you can certainly insulate it because it only affects that one IRA that the prohibited transaction occurred in. So having multiple IRAs doesn't necessarily increase your cost with a custodian per se. If you have, and again, it all kind of depends on what you're doing and how much value you're investing. So I wouldn't say that would necessarily be the concern of me if this was kind of my position I was in of being concerned about a prohibited transaction. I would say, being careful, only utilizing a checkbook control function if I really needed it for what I was doing or was, sufficiently confident that it could be run correctly. Because having the custodian look over everything and, be kind of the eye in the sky, if you will, for what you're doing to an extent can certainly help avoid some of those things. So, Pete, I'm sure I know you've been asked this question a ton. We've actually been in classes together where this has been a topic of a whole day of discussion. So anything you'd like to add to that?
Well, I have a number of friends who've been through some very serious audits, a lot of money. And see, this is really the part of your portfolio that you want to protect at all costs because it is the tax-free part, or at least not in my case. I'm looking at the Roth. And for me to have my tax-free future put at risk, just is crazy. So I'll take all kinds of risks outside the IRA, but I won't do that inside the IRA. And I have seen people lose hundreds of thousands of dollars, and in one case, over $1 million. I've only known of one person whose IRA was essentially confiscated. But in all of those cases where I was close to the people and had discussed the deal, it was evident that they were taking risks in their deal. An example, I think, of that, a simple, much smaller than the millions and the hundreds of thousands I was just talking about, was my daughter and son-in-law are real estate agents in Boston. And Mary called me one day and said, Dad, I've got some people buying a house, and they're being asked to carry they're asking the seller to carry a second. The seller will sell the second mortgage at a discount. Would your IRA be willing to buy this second mortgage? It's second behind a first that's only 3.5% for 30 years. It's being sold. They'll sell it at a significant discount. You're not related to the seller. You're not related to the buyer. Isn't this perfect for your IRA? And I wouldn't have my IRA buy that note, though it was a great note, had my daughter and son-in-law not been the agents in that deal. Because if I bought that note, that cash which my IRA, or if my IRA bought that note, that cash which my IRA paid to the seller created the deal, because the seller would not sell without cashing out the second. And so by my IRA participating, it could be argued that my personal benefit from the action of my IRA was a profit to my daughter and son-in-law. And because of that personal benefit, I would not do that. I know a lot of people who would have said it's worth the risk, or would not have even been aware of the issue that personal benefit can create.
Yeah, it's a great way to put that, and kind of another way to put this, I just kind of recalled in my mind an actual court case. If you want to look it up, it's a tax court memo from 2013, TC.Ellis. Again, TC.Ellis of 2013, kind of going back to the LLC IRA thing. Another reason to be very careful with that is that Ellis was deemed to have been paying himself a salary from his actions as the manager of the LLC. So if you're going to be doing this, obviously you need to make sure that you are clearly defining the separations of it and not getting any direct personal benefit from your IRA deals. That's kind of the big overarching guideline with most of the rules for IRAs, is getting a direct personal benefit, or someone in your direct lineal descendants or ascendants, so mother, father, son, daughter, spouse, getting a direct personal benefit from your IRA. He was acting as the manager of his LLC, which is fine to do that. And the courts have addressed just the managerial aspect, but it leaves a lot of other things open to interpretation. He was paying himself a salary. They audited him, found out about it, and disqualified his IRA. But even in that, they addressed the fact that just the managerial aspect wasn't the problem, it's the fact that he was paying himself. So just another thing to kind of go back to the LLC and the checkbooks and stuff like that is just be careful. They can be done correctly, and they can have consequences if you don't. So make sure you talk it through with us, talk it through with an advisor, do your research, make sure you understand what you're getting into with those kind of things.
Yeah, and imagine paying yourself, causing a deduction against your tax-free account to create taxable income to yourself. Who in the world would do that?
Well, someone did, and it didn't have
I know. I sadly, I bump into those things all the time. But
yeah,
I'm really a capitalist, and so when you give your introduction about you got to go talk to the lawyers and all those kinds of things, when I'm giving you opinion, my opinion is based on the capitalist in me. Because I'm a capitalist, I was able to come out of high school and start acquiring capital, buying some houses. I didn't save up. I actually went and bought some because I was determined to get enough property to fund my lifestyle. So as a simple example of the reason that the Roth IRA is so important to me, let's just say that I need to have $50,000 a year to live on. And let's say that I can get a 5% return on my money. I picked that number because it's easy for us to do the math. That means my IRA has to grow to a point, my capital has to grow to a point where it's $1 million inside a Roth IRA, where the $1 million earns 5%, the $50,000, assuming I've held it long enough and I'm old enough, then gets passed on to me as 50,000 tax paid, non-taxable dollars out of my Roth IRA. If, however, I have that $1 million producing $50,000 outside the IRA, that $50,000 is subject to the theft that we call taxation, and the government steals 25% of it. So that $50,000 becomes $37,500 I can live on, which means I've got to go out and build a $1.4 million portfolio to provide the same income if I do it outside the IRA. So understanding that the Roth is there to help you get to the point where you can live on your capital, I think is a very, very, very important understanding. And it's not only for you, it's for those people with whom you negotiate. When I if I asked Alex, would you lend me some money? And he said, well, yes. And I said, well, I need to borrow $100,000. He said, well, I need 8%. My next question is, well, do you pay taxes? And if I determine that he pays taxes, and I'm going to say, well, in the event that I paid you $8,000 then to use your $100,000 for this next year, how much of that is the government going to steal? And he's going to say, well, it's going to steal 15%. So that means he's going to net 6.8% on the 8. If he's in the 1/3 bracket, he's going to net 5.5%. So at that point, I'm going to say, well, gee, in the event that I borrowed from your Roth IRA instead of from you, now there's no tax. So if I paid you 7%, that's more than you would have gotten, and it costs me less. And so not only knowing about how to use a Roth IRA for your own benefit, but be able to talk to other people about the benefits that they can generate doing business with you and using that Roth IRA as one of their tools, that has been very important to me in structuring deals.
Exactly. It brings up a good point of just understanding that some of the tax benefits of doing this stuff in IRAs. Yes, there are a lot of rules, and I do hear it from time to time of people saying, oh, well, it just makes it so hard and this, that, and the other. I try to tell people, it may make it a little harder, but which one's harder? Abiding by some rules and being very careful, or kicking out 20% of your hard-earned money at the end of the year to the government for which you don't get any direct return on that money that you're sending out. So you're just handing over money just to have a slight bit of convenience. 20% of my profits is not necessarily something I see as a convenience charge. So it's definitely something to look at very objectively with IRAs. Yeah, there's rules. Yeah, there's things that you have to abide by, and the rules are written by the government, so they're not always the most friendly of things. But the benefits can be huge. And essentially, when the government tells you, hey, here's a rule book of how not to pay us money, I mean, what more beautiful thing in the world is there?
Mm-hmm. Well, I'll give you another example. We were trying to buy a property from an estate. And, of course, the estate had 9 heirs in 7 different states, so negotiating with a committee is not an easy thing to do. And, of course, because value is personal and different people like and value different things, I always ask the question, why would you sell a nice house like this? Well, the personal representative said, well, that they need the cash. Now, we know the personal representative of the estate was lying, but he was just parroting what he had been told. Nobody needs the cash. They're going to take that cash, and since cash is merely a conduit taking you from what you want less to what you want more, they were going to take the cash and they were going to go and buy something. And if we could determine what it was, we can more readily make a deal. And so when I talked, there were 9 heirs, and they wanted $90,000 cash for the house. So I immediately realized that the way they'd appraised the property was each kid wanted 10 grand. So I tried, and I finally determined that all 9 of these young being in their 20s to 30, wanted $10,000, not so they had $10,000, but so they could convert it into a car. I didn't have 9 cars, although I was willing to go and get them to make that deal. So I could borrow from one of my friends' IRAs $90,000 at 10% interest only for as long as I wanted. As long as I kept sending him 10%, he'd have been thrilled. I knew another friend whose IRA wanted to buy notes at a discount, and they wanted a minimum discount of 10% off the principal balance because they wanted to create that equity in their IRA. So 2 different people with 2 different goals. And so I bought the property from the estate for $105,000 at 8% interest. And the first mortgage, which I gave to them, which they refused to take because they wanted only cash, I sent them to an IRA that bought that $105,000 first mortgage for $90,000 cash. Now, the reason I was willing to do that is because we hold property. And so by giving a 30-year mortgage, we bought that property with rents that would more than pay the debt service. So that $105,000, had we been going to flip the property, had we been a wholesaler, we would have borrowed from the IRA that wanted the 10% interest, because we could have bought it for 90 and then sold it for 100 and made 10,000 profit and paid off the IRA in a month. But in our case, we wanted to keep the property. So that property is still rented. We are still paying the IRA, my friend's IRA. After 19 years, the $105,000 is now down to $60,000. And it will pay itself completely out over the next 10 years as our tenant continues to pay us. And so those things, doing things on purpose and using the IRAs, not necessarily having your IRA make the deal, is an important part of what's possible out in the marketplace. But you've got to talk to people. You have to spend the time to discover what's in it for them. And knowing that one of those IRAs wanted the higher rate of interest and the other IRA wanted the discount enabled me to choose which source to use to fund my deal.
And I think that's a really good point that you bring up is the amount of additional options that you get when, instead of just looking at something that gets kind of mailed in of saying, hey, here's the deal we want, sitting down, talking about it, and then finding out, oh, well, there's so much more opportunity here than just what was kind of put on the postcard that was stuck on the, hey, here's the investment I want corkboard. It really kind of very well illustrates that. So I thank you for bringing that up. Again, please keep the questions coming in. I'm going to kind of direct this in a direction I think some of y'all will benefit from here in a moment. But again, questions really kind of help drive these things. And if you have a question, this is a great time to get in front of Pete and get that answered. Pete, one thing that you said that you've kind of been seeing more now, you'd mentioned equity participation notes. Maybe if you had like a recent deal or something that had come up with regard to some type of equity participation and how that worked, or maybe some that would be kind of good and anecdotal would be great. Because I personally really find these interesting, that they've become more marketable and more common in the changing marketplace that we've seen with real estate of allowing some participation in the equity or the profits and things like that. So if you want to kind of springboard into that, that'd be great.
All right. I have a young friend. This is maybe a 6 or 7 year old deal in my IRA, and he contacted me, and he had a chance to buy a house to rehab, and he wanted to keep it as a rental, but he had never been able to keep a rental house. He'd been buying houses. He had all kinds of resources to borrow money short term. And so he could borrow the money readily for a year or for even 2 years and do a rehab on the house and sell it and make a profit. But with a 1 or 2 year window, it didn't really work as a rental house for him. And so he contacted me and asked me if I could get him $30,000, and he would put in his own cash for the difference, and he's going to put in $5,000 in cash, and then he was going to do the work himself, but he wanted to keep it, so could I arrange for long-term financing. So my IRA lent him $30,000 secured by a first mortgage. It was an equity sharing note. The interest was defined as $200 a month in stated interest. And then additional interest equal to half of any equity when the property sold above $35,000, which was the 30 I'd put in plus the 5 he'd put in, coming out first before we split anything. And my IRA lent him that money for 20 years, because participating in the equity and having that protection against inflation made me willing to do a 20-year deal with Joe. Now, at that exact same time, another young man, and I'm an old guy now. I'm 70 years old. I really love doing business with the younger guys and watching them come. And I remember the people who helped me and the enormous aid that I received from the older, more experienced enders in my marketplace. And so I love doing it. And so at the same time, I made that 20-year deal with Joe because I got to participate in the upside. Ken, another young man, came to me, and he needed $40,000, and my IRA made a loan to him at 8% for 3 years. I tried to get him to sell me an option, and he said, "Mr. Fortunato, I've known you too long. I'm not giving you an option on my house." And so I was saddened because I would have rather have had upside. But see, I was more than willing to do a 3-year deal at an interest rate with one young man I liked. The other young man got a 20-year term by sharing the appreciation and giving me the inflation hedge. And that's a good, simple, I think, example of an equity sharing arrangement that I did with my IRA, or my IRA did.
And doing this, I've kind of seen the trend kind of peak up more. I have my own general thoughts about why it's happening, but I do feel that it's a very cool and creative way to participate in the marketplace, maybe when people need more of the money that you're lending them or don't necessarily have the ability to make immediate payments or want to defer something, while still making sure that you as the investor, the vehicle that you're using to invest, still has proper skin in the game to actually get some profit with this, because as Pete mentioned, he's a rabid capitalist, if you will. So making sure that there is benefit, not only for yourself but for the other person involved, will really help make these deals something that can be cultivated and done over a long period of time and create the opportunity for repeat business. Pete, I know you can't see it, but I have your case slide up here. So, with that kind of thing, it really is good to illustrate this, of how to break it down, of having the situation, finding the problem, the proposed solution, the benefits, and then figuring out what required documents are there. So, again, these slides will all be on our YouTube channel after this for you to review and print stuff out if you want to go back and kind of generally look at it. So if you want to print this one out to use it, that's another good one. We're getting a little close.
And before you get away from that, remember, the benefits aren't just, there's not just two parties in that deal. See, it's not just my IRA and Joey. It was my IRA and Joe as the buyer and the investor, and the seller who sold him the property, and the tenant who ultimately rented the property, and the rehabber who he hired to do the work. See, there's many people who benefit here. There's lenders, there are rehabbers, there are property managers, there are sellers. And so you're looking at every deal in terms of what's in it for you, certainly, but you need to know what's in it for the other people so you can structure something that makes it worthwhile for them.
Exactly, because when everyone eats, everyone comes back to the same place to keep doing deals. So, it certainly does help that. Lisa, before I we'll get your last question answered. How do you generally find clients to lend to? I've done some note lending, but only people I know or have been referred to by a friend. Before I hand this over to Pete, I'd say that's a great area. A lot of our clients, people you know. That refer by friends. Obviously, for IRAs, making sure that it's not family is a guiding principle with that. But if you can have people that are vouched for, the people that that's a great place to start. And I know Pete is very active in all the local RIAs, different investment groups. And a big thing is being present and attentive and getting to know people. Again, I hate to kind of sound like we're repeating ourselves on this, but having those conversations, across the table with some coffee and sitting down and really getting to know someone is really where a lot of the people that I've just kind of gotten to know in this profession and by extension the investors like Pete, seem to really like, and I hear that those are the ones that get done more often. Can't speak to the success of all of them, but if people continually do something that has to speak to at least a modicum of goodwill and things that are going on with that. Pete, I'd imagine you probably kind of fall along those same lines, but if you have anything to add, I'm sure Lisa would be very appreciative.
I definitely follow. The repeat and referral business is what you build, and you build that by doing what you say you will do, by constructing deals that benefit everybody. And so I like to tell people when I'm talking to them that every deal is a seed, and the deal you do should be the least of the benefits over your lifetime that you get from it, because each deal should lead to more deals and more ease. Gary Johnson likes to say investing is a team sport. And I would go beyond that and say wealth building is a team sport. And as I said, every deal is a seed. And I'll just give you a real quick but really important example. In 1971, I did the most important deal of my life. I went as a 23-year-old kid and bought a triplex from an old guy in his late 40s who was fed up with management. And he was a wealthy guy, and I was a 10,000-aire back in those days. And I bought the property because I was optimistic, I was young, I was willing to tackle the triplex with 3 tenants in it, and he was fed up with management. So we made that deal. I bought the property from him, no money down, subject to his first, and he carried a second mortgage for me. I bought that property. We still have that property in my family. And it's wonderful. It's now, it's free and clear. It's now been 40 plus years. But that one property, which is rented for $4,000 a month, so certainly was a great deal, was a minor part of the benefits that came from that deal. John, the gentleman that I bought the property from, and I did 27 transactions over the next 29 years, but then he passed away in 2000. So think of that. One deal with no money down led to 27 transactions. On top of those 27 transactions, there was any number of referrals that he gave to me. On top of that, I've done 4 deals with his son-in-law. And on top of that, he introduced me to the bank where I took subject to his first mortgage. And that banker and I, back in the 70s, did 5 different deals. So that's what should be happening if you're paying attention to the relationships that come from each and every single deal. Alex mentioned that I go to the meetings regularly because I want to know what's going on. I talk to people, And because benefits can be generated for many people in any deal, I know and I actively participate in the exchange meetings, in the real estate meetings, in the Monday night meeting. I interfere in the lives of everybody around me, and I never stop. But I had a friend last year who got very sick, and I owed him $100,000, and his family called and said, can you pay us back? We'd really like to have the cash available because Dad's going into the hospital. And so I went to Monday night meetings after that weekend. So it's probably been 3 days since they called me. And at the meeting, I said, my friend, I owe him $100,000. Here's the situation. Would anybody like to buy the note that I owe to Mark, and I'll pay you? You can pay Mark. Or lend me the money so I can pay Mark. And 3 people at Monday night meeting offered to come up with the $100,000 that I needed so that I was able to get that money to that family within just a few days. Well, you think of the efficiency of that. Now, because we're here talking with Advanta and talking about IRAs, I just tell you, of those 3 people, one of them had the money in a Roth IRA. And I chose from 3 very good friends to do business with the one that had the money in the IRA because I didn't like sharing any part of it with the government or having anyone else share it with the government. So
Amen.
I made the deal with the Roth IRA.
Yeah, so we're getting a little bit close up on time. We have one more question that I think you'll really like on because it hits right to the locus of what you do, Pete. And let me guess, that gentleman that you bought the triplex from, did that kind of seed from a conversation to begin with?
That came from a what do you call it? An open house sign. And I drove down the street, and here was this guy. 47 years old, and John and I became very good friends. It's amazing how what a great financial friend and friend he became over those years. And it started because as a 20-year-old kid, I walked up and I was his solution because I would take on the work, and he was fed up with it.
Fantastic. So Robert asks, and it kind of goes right along the slide. I'm on the T-bar right now for your visual, Pete.
Yeah.
Robert's interested to know how or why capitalists always give better than they take, and how does deals close, or how do deals close? Explain this.
All right. I got a referral. So I did not know the lady, but she was referred to me, which meant she had some confidence in me because her neighbor had referred her. And she had a house out at the beach near me. And so I went and met with her. And my first words out of my mouth were, why would you sell a nice house like this? And she explained to me that the doctor had told her she could not handle stairs any longer. So I asked her if she had a family back home she wanted to move back to. And as we talked, it turned out her family is in Pinellas County. The church she's very active in is out at the beaches. Her home is out on the beaches. And so we made a deal. I gave her a condominium in an elevated building in exchange for the equity in her house that had 2 stories. Now, why did she do that deal? When she moved, she's got to stay close to her church and her family and her friends and neighborhood she knew. She eliminated yard work. She eliminated stairs in an elevator building. I got a house without a homeowners association, which really appealed to me. Now, we were both happier. That's why the deal closed, because I liked what I got more than I liked what I gave up. And the lady liked what she got, the condo, better than what she gave up, a house with stairs. And that's why you can absolutely rest assured that capitalists always give better than they take, because absent of coercion, people will not take something they like less than what they give up.
I think that's a very poignant and pointed sentence to close on. Pete, I have your little flyer up here for the classes coming up on 23rd and 24th. Personally, thank you very much for being a part of this. It means a lot to us here at Advanta to help bring your knowledge and experience out to the masses of the people that interact with us and ultimately, are going to benefit from this quite a bit. What I would like to say as well is that, personally, I can also vouch, not just as a, professional in my capacity with Advanta, but if you have the ability to go to one of Pete's classes, they are fantastic. I have learned a very large amount of information from Pete over the years, and going to his classes and getting to meet the people there that have been going for years to hear him speak, and being able to do it for significantly cheaper than what some of the other large national people talk about, and whether or not some of the larger national people have the experience that he does is very up for debate. But you get a great deal. It's, again, 23rd and 24th. The registration's right here. You can also find it on his website. Your website's what? PeteFortunato.com?
PeterFortunato.com, yep.
You can find the registration there. I do encourage you to take a look at that. This recording will be up on our website. If you have any questions, my contact information is now up in front of you, so is Pete. So feel free to reach out to either of us. We're happy to answer questions. Obviously, Pete has a significant amount of years of experience on me, so if you have an IRA question, I'm happy to field it. But if you want some sage wisdom on the area of real estate investing, Pete is certainly your man. So again, Pete, thank you very much for being a part of this. Everyone here, thank you for being a part of this as well. We have one question here. I guess we'll get to it before we finally close up. Samuel asks, using that scenario Pete just gave on the loan from an IRA, does that mean that every time I receive PF and it's not from an IRA, it will have to be reported?
Every time he receives PF, I don't know what.
PF.
If he made a payment to the IRA, then he would most likely deduct it, assuming it was a business or an investment loan.
Oh, he said private funding. So okay, so this makes a little bit more sense. Using the scenario Pete just gave, does that mean every time I receive private funding and it's not from an IRA that it will have to be reported?
Well, there's nothing to report if you borrow money. So I'm assuming we're thinking taxes. So maybe there's something else he's thinking about. But he would want to deduct the interest, I would think.
Yeah, and that doesn't necessarily matter where it comes from so much. It matters more towards what entity you're borrowing in, whether or not it's a homesteaded property, and a lot of other things. So yeah, that would be the answer I would have. And I think, Pete, you kind of agree with that one, correct?
Yeah.
All right. Well, great. Again, Pete, thank you very much for being with us. We really appreciate every single one of you that was with us as well. This recording and slides will be up on our YouTube channel probably later today, or at least by week's end. Wishing everyone a wonderful long weekend. I want to thank anyone that did serve our country for this Memorial Day weekend. Thank you for serving our country, and we certainly do appreciate that. So again, everyone have a wonderful day, and thank you very much, Pete.
All right. Thanks, Alex. And I really appreciate Advanta and what you've done for me and my friends.
Oh, we certainly appreciate you as well. Have a good one.